So imagine a charitable organization, right? Like every single day, they use their funds to feed orphans, run shelters, and provide disaster relief.
Yeah, doing really vital work.
Exactly. Now, imagine the Philippine government stepping in and taxing the money that this charity uses to do all that good work.
I mean, it sounds entirely impossible. Why would the government tax a charity?
Right. But if you don't understand the exact mechanics of Section 30 of the Philippine Tax Code, you might just assume they're 100% exempt,
And you will definitely get that question wrong on board exam day.
which we do not want. So welcome to this deep dive, tailored specifically for you, the determined CPA board exam candidate tuning into ICPA Review Radio.
Glad to be here with you all.
Today, we are conquering Sections 27, 28, and 30 of the tax code. Our mission is to just, filter out the dense legal jargon and zero in on exactly what those examiners are going to test you on.
Think of me as your strategic reviewer today. We're going to analyze the underlying philosophy of these rules.
Because memorizing isn't enough, right?
Exactly, because when you understand why a tax provision exists, you don't have to rely purely on rote memorization. You can actually deduce the correct answer when you're staring down a complex four-paragraph multiple-choice problem.
We're in this together. So here's our roadmap. We're starting with the default rules for domestic corporations and analyzing the special relief for MSMEs.
And then we'll navigate the tricky waters of educational institutions and tax-exempt entities, like that charity scenario you just mentioned.
Yep. After that, we'll decode the minimum corporate income tax and finally cross borders to tackle the rules for foreign corporations. So let's get right into it.
Let's lay the foundation with the baseline rule. So under Section 27A, domestic corporations are generally taxed at a rate of 25% on their net taxable income.
Okay, 25%.
Right. And the core principle you have to remember here is jurisdiction. Because a domestic corporation is organized under Philippine laws, it receives the full protection and benefits of the state.
Makes sense.
Therefore, it gets taxed on income derived from all sources, both within and without the Philippines. It is a worldwide tax base.
Okay, let's unpack this for a second. Because 25% on worldwide net income sounds like a massive burden, especially for a small startup just trying to keep the lights on.
It is a heavy lift.
You're right.
Yeah.
If the government wants to encourage entrepreneurship, slapping a 25% tax on a mom-and-pop operation seems counterproductive.
Yeah.
Isn't there a VIP room for the smaller players trying to grow?
There is, and it is a highly testable area on the exam. The law actually carves out a preferential rate of 20% specifically for micro, small, and medium enterprises, or MSMEs.
Oh, nice. But I'm guessing it's not easy to qualify for?
No, the examiners will heavily test the threshold criteria here. To qualify for that 20% rate, you must meet two conditions simultaneously.
Okay, grabbing my mental highlighter. What are they?
First, the corporation's net taxable income cannot exceed 5 million pesos. And second, their total assets cannot exceed 100 million pesos.
And here is where the blueprint gets tricky for you guys listening. The examiners aren't just going to hand you those asset numbers cleanly. There has to be a catch with that 100 million peso limit.
Oh, there's a massive catch. The tax code explicitly states that the 100 million peso asset threshold excludes the land.
Wait, excludes the land?
Yeah, the land on which the particular business entity's office, plant, and equipment are situated.
I mean, I'm trying to think through the logic of that. Why would the government exclude the land? Land is a highly valuable asset. If a company owns a 50 million peso lot in Metro Manila, they're obviously pretty well off. Why ignore it?
Because the tax code is trying to measure the operational size of the business, not their real estate luck.
Oh, okay.
Imagine a small shoe manufacturer that bought a piece of land in the provinces like 40 years ago. Over the decades, urban development happens, and that land is suddenly appraised at 80 million pesos.
Wow, okay.
But the business itself is still just a small shoe factory barely making 1 million pesos a year in profit. If you included the land, they'd be classified as a large corporation and hit with the 25% rate.
Which would crush them.
Exactly. Excluding the land levels the playing field and looks strictly at the assets actually driving the daily operations.
That makes perfect sense. So let's translate that into an exam problem. If a multiple choice question states a company has total assets of 110 million pesos, a candidate rushing through the exam might see that number, think over 100 million, and immediately apply the 25% rate.
Exactly. But if you read carefully, the problem will casually mention that 20 million of those assets represent the land where their main factory sits.
Sneaky.
You have to actively subtract that. So 110 million minus 20 million leaves you with 90 million in qualifying assets. They actually do meet the criteria for the 20% rate.
Right. And if you forget to subtract the land, your entire computation is doomed from step one.
Absolutely doomed.
So we've got the for-profit businesses sorted based on operational size. But let's build a logical bridge here. If the tax code adjusts for the size of a business, how does it adjust for the purpose of a business?
What do you mean?
Well, not all corporations exist to maximize shareholder wealth, right? How does the code treat organizations serving the public, like private schools and hospitals?
This is where tax policy directly supports social policy. Nonprofit hospitals and proprietary educational institutions enjoy a very preferential 10% rate on their taxable income.
Wait, what defines a proprietary educational institution for the exam?
Great question. It means private schools with valid permits from DepEd's, CHD, or TESTA. If they have that, they get the 10% rate.
But I imagine the government doesn't just hand over a 10% rate blindly forever. There has to be a mechanism to ensure these institutions are actually focusing on education or health, right? And not just acting as a front for other businesses.
You hit the nail on the head. That mechanism is called the predominance test.
Okay, the predominance test.
The government is effectively saying, we will give you this low 10% rate to subsidize your educational or medical mission. But if your unrelated commercial activities start generating more revenue than your core mission, you lose it.
You're no longer primarily a school or a hospital.
Right. You're a commercial enterprise.
Let's walk through the math on that, because I know this shows up in computational questions. Say we have a private school. They earn 10 million pesos from student tuition and laboratory fees.
Okay, 10 million core income.
Yep. But they also own a prime piece of commercial real estate downtown, and they make 12 million pesos a year, renting spaces to fast food chains and retail stores.
That is a classic board exam scenario. You have to compare the gross income from the unrelated trade or business against the total gross income.
So the unrelated rental income is 12 million.
Right. And the total gross income from all sources is 22 million. You divide 12 million by 22 million, which is over 54%.
Oh, wow.
Because the unrelated income exceeds 50% of the total gross income, they fail the predominance test.
So they lose the 10% rate. But wait, do they just lose the 10% rate on the rental income? Or does it affect the tuition too? Because taxing the tuition at a higher rate seems like it penalizes the students.
It is a harsh rule, but the concept is contamination. Once you fail that test, your entire entity loses the privilege.
No way. The entire thing?
The whole pot. Both the 10 million in tuition and the 12 million in rent is now subject to the regular 25% corporate income tax rate. The preferential status is completely revoked for that taxable year.
That is a brutal trap. You aren't just losing the discount on the side hustle, you are contaminating the core operations.
Precisely. Now, keeping with the theme of public service entities, we really need to discuss Section 27C, which covers government-owned or controlled corporations, or GOCCs.
Okay, here is where it gets really interesting. Because I know a lot of candidates logically assume, well, it's the government. The government isn't going to tax itself, right? That's just moving money from one pocket to another. So they must be exempt.
And that assumption will cost them points. Section 27C is very clear. GOCCs are taxable by default.
By default, why?
Because many GOCCs compete directly with private enterprises. If a government-owned bank or a government-owned casino paid no taxes, it would have an unfair competitive advantage over private banks and casinos.
Well, of course.
So they pay the same 25% tax on their taxable income as private corporations.
That economic rationale really clarifies things.
Yeah.
But there are exceptions to this default rule, right? Certain government corporations that genuinely don't compete with the private sector.
Yes, there are 5 major exceptions that are completely tax exempt. And we use a mnemonic to lock these in for exam day. It's GSHPW. Think of it as good students have passed waters.
Good students have passed waters. I love that. Let's break those letters down.
Sure. G is for GSIS, the Government Service Insurance System. S is for SSS, the Social Security System. H is for HDMF, better known as PAG-IBIG.
Right.
P is for PHIC, or PhilHealth. And W is for local water districts.
Okay, so just those 5.
Right. These entities provide essential monopolistic public services. So taxing them would just deplete the funds meant for citizen benefits. If the exam question features one of those 5, it's exempt.
But if it's like the Philippine Charity Sweepstakes Office or the Civil Aviation Authority,
They are fully taxable.
okay, that brings us right back to the provocative scenario I opened the show with. We talked about a charity feeding orphans. Section 30 covers non-stock, non-profit organizations, labor organizations, civic leagues, religious and charitable institutions. Their core activities are completely tax-free, right?
Yes, the core mission is shielded. The church's tithes, the charity's donations, the dues collected by a labor union,
All exempt.
all exempt. But the ultimate Section 30 trap hinges on the difference between an exempt entity and exempt income.
Ah, good.
The law states that notwithstanding their exempt status, any income of whatever kind and character from any of the properties, real or personal, or from any activities conducted for profit, is fully subject to tax.
Okay, so if that charity takes its surplus donor funds and invests them in the stock market to earn dividends, or if they own a building and rent out the ground floor to a coffee shop to generate extra operational cash, that specific income is taxable.
Exactly. And the trap is that candidates think the destination of the funds matters.
Oh, like the exam problem will explicitly tell you 100% of the rental income from the coffee shop was used exclusively to buy food for the orphans.
Right. And the candidate thinks, oh, it went to charity, so it must be exempt.
But the tax code only cares about the source, not the destination.
Correct. The source of the income was a commercial rental arrangement, which competes with private commercial landlords. Therefore, the rental income is taxable, regardless of how nobly the profits are spent later.
So we've seen how the government taxes a charity if it acts like a landlord to level the playing field. That makes structural sense. But what happens if a regular, for-profit business stops acting like a business and just acts like an investor?
Like,
Say they just park their excess cash in a bank to earn interest, or they sell off some old real estate. How does the tax code treat that?
we are now entering the realm of final withholding taxes on passive income. The philosophy here is administrative efficiency.
How so?
Instead of making the corporation declare this income at the end of the year and deduct expenses, the government mandates that the entity paying the income, like the bank, must withhold the tax immediately before the money is even paid out. It's a final tax.
Which means no deductions allowed. What are the rapid-fire exam rates candidates need to memorize for this?
Okay. Interest from regular domestic currency bank deposits is subject to a 20% final tax. Capital gains from selling shares of stock in a domestic corporation that are not traded through the local stock exchange are subject to a flat 15% on the net capital gain.
Got it. And what about real estate? If a manufacturing company decides to sell a vacant lot they bought years ago but never used.
That is treated as a capital asset. Capital gains realized from the sale of lands or buildings treated as capital assets are subject to a final tax of 6%. But the computation is what catches people off guard.
Right, because the examiners love to give you multiple valuations. They will give you the gross selling price, the fair market value, the zonal value, and the original cost of the land.
And you must ignore the original cost entirely. The 6% tax is based on whichever is higher between the gross selling price or the fair market value.
Okay, higher of the two.
Yeah. Usually that fair market value is determined by the zonal value set by the Commissioner of Internal Revenue. The government is essentially saying, we aren't going to audit your original receipts from 20 years ago. We are presuming a gain based on the current gross value of the transaction.
That is a critical distinction to remember. Now, let's look at another form of passive income. Intercorporate dividends. If a domestic corporation receives dividends from another domestic corporation, it's exempt.
That makes perfect sense. The profit was already taxed when the first corporation earned it. Taxing it again when it's passed to the second corporation would just be double taxation. But what if our domestic corporation gets a payout from a foreign subsidiary, say a subsidiary located in a tax haven?
Historically, that was fully taxable,
Right.
but under recent amendments, foreign-sourced dividends received by a domestic corporation can be exempt.
Oh, wow.
However, the conditions to claim that exemption are incredibly strict to prevent exactly what you mentioned. Corporations just parking money offshore to dodge taxes.
So how does the government force the corporation to prove they aren't just dodging taxes? What does the reviewee need to look for in the problem?
Two major hurdles. First, the reinvestment rule. The funds received must be actually remitted into the Philippines and reinvested into the domestic corporation's business operations within the next taxable year.
So they have to spend it here.
Yeah, it has to fund working capital, capital expenditures, dividend payments, or infrastructure projects. You have to prove the money is generating local economic activity. I imagine just reinvesting isn't enough, though. Because you could just temporarily park the money in a foreign shell company, immediately declare a dividend, bring it back, and claim the exemption. Does the government force you to hold the shares for a certain amount of time to prove it's a legitimate long-term investment?
Yes, that is the second hurdle. The holding period and ownership test. The domestic corporation must hold directly at least 20% of the outstanding shares of that foreign corporation.
20%.
And they must have held those shares for an uninterrupted period of at least 2 years at the time the dividend is distributed. If you only own 15%, or you've only held it for 18 months, that dividend is fully taxable as regular corporate income.
The layers of compliance are just intense. Which brings me to a broader thought, really. We have all these regular rates, MSME rules, allowable deductions, and exemptions. A clever accountant could theoretically maximize expenses, utilize every deduction, and reduce a corporation's net taxable income to zero year after year.
The government is well aware of creative accounting, which is why they installed a safety net, the Minimum Corporate Income Tax, or MCIT.
So what does this all mean?
The economic philosophy behind the MCIT is essentially a toll fee. If you are a corporation operating in the Philippines, utilizing the roads, the legal system, the police protection, and the infrastructure of the state to run your business, you must contribute something to the upkeep of that society.
You can't just be a freeloader.
Exactly. You cannot perpetually claim zero income while utilizing state resources.
The state always gets its slice. So how does the MCIT computation actually work on the exam?
The MCIT rate is 2% of gross income. It kicks in on the fourth taxable year immediately following the year the corporation commenced business operations.
Why the fourth year? Why not immediately?
Well, because the government recognizes that startups bleed money. It takes time to build a customer base and turn a profit, so they give you a 3-year grace period.
Okay, that's generous.
Yeah. If you start operations in 2020, year 1 is 2021, year 2 is 2022, year 3 is 2023, you have breathing room. But by the 2024 taxable year, the MCIT kicks in.
And how do you compare it?
At that point, you compute your normal income tax, say 25% on net income, and you compute 2% of your gross income. You pay whichever is higher.
But if a company legitimately suffered a massive loss, paying a tax based on gross income could bankrupt them. Is there any relief?
There is. Any excess of the MCIT paid over the normal income tax can be carried forward and credited against normal income tax for the next 3 immediately succeeding taxable years. It's basically a temporary advance to the government.
Here's where I want to push on the actual exam mechanics, though. Computing the 2% sounds easy, but defining gross income in accounting is notoriously subjective.
It is highly specific for tax purposes, and this is exactly where examiners lay traps. For a trading or merchandising concern, gross income means gross sales, less sales returns, discounts, and allowances, less the cost of goods sold.
And what goes into that cost?
Cost of goods sold only includes direct costs, so invoice costs, import duties, and freight in.
Okay, and what if the taxpayer provides a service like an auditing firm or a consulting agency?
For services, it's gross receipts less the direct cost of services. This includes salaries of personnel directly rendering the service and the cost of facilities directly utilized. The key word is direct.
Right.
General administrative expenses, advertising, the salaries of the HR department, none of those are deductible when computing gross income for MCIT. The examiners will list all those general expenses just to tempt you to deduct them.
Ignore the noise.
Exactly. Stick strictly to direct costs.
Okay, we've squeezed every drop out of domestic operations, but we live in a globalized economy. A CPA candidate isn't just going to deal with local companies. The exam will definitely feature foreign corporations operating in the Philippines.
Absolutely. Section 28 splits foreign corporations into 2 distinct classifications based on jurisdiction. Resident foreign corporations, or RFCs, and non-resident foreign corporations, or NRFCs.
I've always found it helpful to use an analogy here for the listeners. Think of an RFC as an expat. They are a foreign entity, but they have a physical branch here. They are engaged in trade or business on Philippine soil.
That's a great way to look at it.
Right. And an NRFC, on the other hand, is like a tourist, or a foreign bank with no physical office here that just happens to lend money to a Philippine company. They earn income from the Philippines, but they are not engaged in business within the country.
That analogy perfectly explains how they are taxed. Because the RSC, the expat, is here on the ground, we tax them very similarly to a domestic corporation. They are taxed at 25% on their net taxable income.
Okay, net income.
But importantly, only on income from sources within the Philippines. We don't have jurisdiction over their global operations. And because we tax their net income, they are allowed to claim business deductions, and they are subject to the MCIT safety net we just discussed.
Wait, hold on. I'm confused about how the tourist, the non-resident foreign corps, is treated. If the expat RFC gets to deduct their expenses and pay tax on the net, what about the NRFC?
What's fascinating here is the NRFC is taxed at 25% on their gross income from Philippine sources. No deductions allowed whatsoever.
That seems, incredibly unfair. We are taxing a foreign entity 25% on gross revenue. Why wouldn't they just avoid doing business with the Philippines entirely? Why the drastic difference in treatment?
It all comes down to enforceability. The Philippine government cannot send BIR auditors to a company headquarters in Switzerland to verify their operational expenses.
Oh, true. We have no jurisdiction.
Right. So to protect the tax base, we cannot allow them to claim deductions we can't verify. Instead, we mandate that the Philippine company paying the foreign entity must withhold 25% of the gross amount before the money ever crosses the border. It's a purely practical mechanism to ensure the tax is collected.
That makes a lot of sense. The withholding agent is the fail-safe. But I know there are exceptions to that 25% rate for NRFCs, rates the candidates just have to commit to memory.
Yes, there are 3 specific high probability rates you must know. Non-resident cinematographic film owners or distributors are taxed at 25% of gross income.
Okay.
Non-resident owners or lessors of vessels chartered by Philippine nationals are taxed at 4.5% of gross rentals. And non-resident owners or lessors of aircraft, machineries, and other equipment are taxed at 7.5% of gross rentals.
Wow.
Examiners love to test if you know the difference between the 4.5% for vessels and the 7.5% for aircraft.
Got to flashcard those. Let's do one final scenario. What if our expat, the resident foreign corporation branch, makes a bunch of profit here in the Philippines, pays its regular corporate tax, and now wants to send the remaining cash back home to its mother company abroad?
That triggers the branch profit remittance tax, another classic board exam computation. Any profit remitted by a branch to its head office is subject to a 15% final tax.
15%, okay.
But the crucial detail is the tax base. The 15% is based on the total profits applied or earmarked for remittance without any deduction for the tax component itself.
Meaning, if the branch earmarks 100,000 pesos to send home, you calculate 15% of the full 100,000. You don't try to back into a net amount. The tax is simply 15,000 pesos.
Exactly. Keep it straightforward. Earmarked amount times 15%. The only major exception is for branches registered with PIZA, the Philippine Economic Zone Authority. They are exempt from this remittance tax as an investment incentive.
We have covered a massive amount of ground today. If I'm taking this exam tomorrow, here is my rapid-fire mental whiteboard checklist of the biggest traps to watch out for. First, when looking at the MSME 20% rate, I'm checking the 100 million peso asset threshold, and I'm actively deducting land value from that total.
Second, watch out for the predominance test. If a private school or nonprofit hospital's unrelated commercial income crosses that 50% mark of their total gross income, they don't just lose the preferential 10% rate on the commercial side. You must apply the regular 25% rate to their entire taxable income.
The whole pot is contaminated. Third, I'm remembering that most government corporations are fully taxable, except for the Big Five. I'm recalling the mnemonic GSHPW for GSIS, SSS, HDMF, PHIC, and water districts.
And finally, number 4, categorize foreign corporations based on jurisdiction. Resident expats are taxed on net income, while non-resident tourists are taxed on gross income because we can't audit their offshore expenses.
That's a solid exam day checklist.
It is. But before you sit down for your exam, if we connect this to the bigger picture, ponder this final thought. The rules we discussed today rely heavily on physical concepts. Where a plant is situated, whether a foreign company has a physical branch in Manila, or where a piece of paper for a dividend is held.
Very tangible stuff.
Right. But as digital nomads, global remote work, and cloud-based services completely erase traditional borders, how long until the concepts of resident and non-resident foreign corporations become obsolete?
Oh, wow.
Will the Philippines eventually have to tax based purely on digital presence and user data rather than physical branches? Keep an eye out for how the law evolves in your future practice.
That is a fascinating question, and one you will be well equipped to answer once you have those three letters, CPA, attached to your name. Remember, the tax code isn't just a list of random rules, it's an economic ecosystem. Ask yourselves who is benefiting and how the government gets its slice. Understand the philosophy, look for the traps, and trust your preparation. Good luck on the board exams, you've got this.